Today, March 21st, 2026, gold just fell to $4,193 per ounce, down from an all-time high of $5,189 only weeks ago. That's almost $100 lost in a matter of weeks. People are panicking, forums are exploding, social media is screaming gold is dead. But here's what nobody is telling you right now. The last time gold fell this hard, this fast, the people who bought the dip made unthinkable returns in just months. And today I'm going to show you, step by step, whether this is the dip you've been waiting for or a trap. Stay with me, because what I reveal at minute 4 will change how you look at this correction forever. Let's talk about what actually happened. Gold was flying. It hit $5,180 on January 28th, 2026, an all-time record. Then it started falling. And this week it crashed hard. As of today, gold sits at approximately 4,190 thrives per ounce. That's a drop of nearly 18.5% from the January peak. 7 consecutive losing sessions, the longest streak since 2023. So what caused this? 3 things, and listen carefully. Number 1, dollar strength. A stronger US dollar makes gold more expensive for international buyers. Demand drops, price drops, simple math. Number 2, the Federal Reserve held rates steady at 3.5% to 3.75% on March 18th. But the tone from Jerome Powell was hawkish. He signaled one rate cut maximum for all of 2026. Gold doesn't pay interest. So when rates stay high, investors prefer cash and bonds. Gold loses short-term appeal. Number 3, oil shock from the Middle East conflict. Iran and the Strait of Hormuz situation pushed crude prices sharply higher. Higher oil means higher inflation. Higher inflation forces the Fed to keep rates elevated. That's bad for gold in the short term. Institutional investors saw this. They rebalanced portfolios. They took profits after a 55% rally. Forced liquidations in the futures market created a cascade. That's what you're seeing on your screen right now. But here's what's shocking, and most channels won't say this. The physical gold market told a completely different story. While paper prices crashed, physical gold premiums stayed elevated. Demand from real stackers, jewelers, and institutional buyers held steady. You cannot get a margin call on a gold coin. Think about that. So should you buy right now? Let me walk you through this step by step. Step 1, understand what you're buying. This is a correction inside a bull market, not a collapse. The 200-day exponential moving average sits around $4,200. As long as gold holds above that level, the uptrend is intact. We're currently above it. Breathe. Do not buy from random social media sellers. Only use trusted, licensed dealers. In Spain and Latin America, look for regulated bullion dealers with VAT receipts and certificates. In online markets, established platforms with buyback programs are your best friends. For ETFs, use a regulated broker and look for physically backed gold funds, not synthetic ones. Never pay more than 3% to 5% premium over spot for standard coins or bars. Step 3, choose your format wisely. Physical gold, coins like the Vienna Philharmonic, South African Krugerrand, or American Gold Eagle. These are globally recognized and easy to sell anywhere. For beginners with less capital, gold ETFs are a valid entry point. Lower costs, easier management. But for real protection, nothing beats holding the physical metal. Step 4, storage. At home, use a quality, fire-rated safe bolted to the wall. Tell nobody what you own. For larger amounts, consider a bank vault or professional storage service. Do not store your gold in a photo album or a shoebox. I'm serious. Step 5, avoid these errors. Error 1, buying all at once. Never go all in at a single price. Use dollar cost averaging. Buy in portions over weeks or months. Error 2, panic selling during dips like this one. The people who sold gold at $3,000 when it looked scary are crying today. Error 3, buying numismatic collector coins as an investment. Premiums are enormous. Stick to standard bullion. Now here's where it gets interesting. Because while retail investors panic, the biggest financial institutions on the planet are maintaining their bullish outlook. And the numbers they're publishing are explosive. JP Morgan has a year-end 2026 gold price target of $6,300 per ounce. Read that again, $6,300. From today's 4,490 throws, that's 40% upside remaining on the table. Deutsche Bank sees $6,000, UBS targets $6,200. Goldman Sachs raised its forecast to $5,400. Wells Fargo Investment Institute, $6,100 to $6,300. Morgan Stanley bull case, $5,700 in the second half of 2026. Every major bank on Wall Street is pointing in the same direction. And JP Morgan even published an upside scenario, not a base case, but a real modeled scenario, of $8,000 to $8,500 per ounce if the household allocations to gold rise from 3% to 4.6% of portfolios. Is that guaranteed? No. But when JP Morgan models it, you take notice. Meanwhile, the World Gold Council confirms that geopolitical uncertainty, fiscal deficits, and central bank demand continue to support gold's long-term trajectory. The structural case has not changed. The fundamentals are intact. What changed this week was sentiment and positioning. That's short term. The big picture is still pointing up. Now here comes the part they never tell you, the part the mainstream financial media glosses over, the part that's happening quietly while retail investors panic sell. Central banks and the institutions that control the global monetary system are still buying gold right now during this dip. JP Morgan's research forecasts approximately 800 tons of central bank gold purchases in 2026 alone. That's still more than double the pre-2022 historical average of 400 to 500 tons per year. In 2025, central banks bought 863 tons combined. And a survey from mid-2025 revealed something warning level significant. 76% of central bank reserve managers expected gold to form a much larger share of their reserves within 5 years. 95% expected their gold reserves to grow in the coming year. Let me ask you something. When was the last time your bank manager called you and said, "Hey, we're moving more into gold and less into dollars"? They don't tell you, but their actions speak clearly. What they're doing quietly is diversifying away from the US dollar. They're reducing their dependence on a currency backed by $39 trillion in debt and growing. And they're choosing gold. The same gold that just fell to $4,493. The same gold you're hesitating to buy today. There's a word for the gap between what institutions do quietly and what they say publicly. That word is opportunity. All right, let's get practical. What should you actually do with this information? How much should you allocate to gold? The standard recommendation from financial advisors is 5% to 15% of your total portfolio. If you have zero exposure right now, start at 5%. If you're more risk conscious or believe in the macro case strongly, go up to 10%. Only veterans and dedicated precious metals investors go above 15%. Don't be a hero, be strategic. Physical versus ETF, the real answer. Physical gold is for protection. It's for the worst case scenario, currency crisis, banking instability, reset of the monetary system. ETFs are for capital appreciation and easier portfolio management. The smart strategy? Both. Hold at least 50% of your gold allocation in physical form. The rest can be in ETFs for flexibility. Dollar cost averaging right now makes total sense. You don't need to catch the exact bottom. Nobody does. If gold is at $4,193 today and falls to $4,200, you buy more. If it goes back to $4,800 next week, you've already started building. Spread your purchases across 4 to 6 weeks minimum. Be methodical. Remember, gold's role isn't just to make you rich, it's to protect what you already have. In a world of rising debt, persistent inflation, and geopolitical uncertainty, that protection has a real and growing value. The $39 trillion US debt pile isn't shrinking. The dollar isn't getting stronger long term, and the Fed can't raise rates forever. When those dynamics shift, and they will shift, gold will explode back to its highs and beyond. The question is not if. The question is whether you're positioned when it happens. So let me ask you directly. Are you going to let this dip pass you by? Or are you going to act like the central banks act? Quietly, strategically, and without panic? I want to know what you think. Drop a comment right now and tell me, are you buying this dip, waiting for lower prices, or staying on the sidelines? And if this video gave you real practical information you didn't have before, smash that like button. It genuinely helps this channel reach more people who need this information. Subscribe if you're new here. Every week we break down the metals market, no fluff, no hype, just the real numbers and what they mean for your money, and share this with one person in your life who is asking about gold right now, because they deserve the truth too. I'm telling you, the window of opportunity during corrections doesn't stay open forever. Do your research, make your decision, and we'll talk again next week. See you there.